here, just to help the sync. And me, I'll do it.
Only.
No, just me. Yeah. That's good.
I think he said you all do it.
That's what I thought too.
Welcome to the Money Mindset. Thanks for joining us. Eddie, how's it going, man?
It's going great. Love working in our job, what we do for people, and how we help people every day. It's exciting.
I know we're busy. I know right now you're on the phone. We're all on the phone, texting back and forth. People are ready to start saving on their taxes, man. I know that time is the essence. People don't realize that you need to start Early.
Yeah, it's very important that people start early because we get a lot of calls around November, December. Sometimes, actually most of the time, by that time we can't do much. So planning starts, way ahead, even the year before.
Yeah, I know this past year people were just trying to get in, and I mean we're swamped. What ends up happening? They end up paying a little bit more because you're paying a premium now because I mean we're busy, and then a lot of our strategies are. Some of them are already loaded up. They're taken, and so we got to look for other things to do for our clients. But
and the other thing is, at the end of the year, you got all the holidays.
Yes, yeah.
So people are busy with family, a lot of things happening, and then you got one more thing to worry about. So, don't put more burdens on yourself than you need to. And this show is called the Money Mindset, and I think that's part of what we're talking about here is planning ahead of time.
Yeah.
And it involves a shift in your thinking from tax filing to tax planning. And it's a very different frame of mind.
Yeah, last week Lauren was here with me, and we're talking about that planning starts January 1st, man. So the sooner the better. I know that I mean, people who haven't really, or not people who are not our clients have, they're not thinking about planning ahead of time. Usually what they're used to this in November, start gathering all their receipts and stuff like that, and panicking and not knowing what's going to happen. But that's where the planning comes into place, where they already know what to expect.
And it's not always necessarily just business owners that have this issue. You got people that are going to be retiring, or they're going into their Medicare years, and they don't know anything about Medicare.
Exactly.
And I shouldn't say anything. I'm sure they know some stuff about Medicare, but it's the little stuff that catches people off guard.
Yes.
It's not the stuff you see coming a mile away that's going to get you. It's the stuff that sneaks up on you, and you say, nobody told me about this. I wasn't expecting this.
Yeah.
Well, those are the kind of things that you plan ahead for.
Yeah.
And we can make you aware of. And I think we're going to talk about one of those, right?
Yeah. So we're looking at some news articles. This one was from. Let me see which. I know this one was. I want to be sure to mention the
source.
The source. I know we had talked about that earlier. Let me go ahead and look that up. But anyways,
while you're looking for it, I can tell people what it's about.
Yeah. Go ahead.
This is about. The title of the article is the RMD tax trap: hiding your $2 million 401k. How to avoid the IRMA surcharge 2 years later. Yeah,
this is from BerkshireEdge.com. So yeah, I mean that's huge. People don't even know what IRMA is. Number one.
It's not a lady.
It's not a lady. But yeah, so people don't know about that, and there are ways to decrease the IRMA. Well, I guess talk a little bit what
it
IRMA is. Yeah.
Let me see what the acronym stands for. I forget what the acronym stands for, but it has to do with income related monthly adjusted something. It's a surcharge. It's an additional fee that you're gonna pay if your income exceeds a certain threshold. And the tricky part about it is they're not looking at your current income. They're looking at your income from 2 years before.
Oh wow.
So, you could have retired taking out money from your 401k, and now you go into Medicare, and your income is lower, and surprise, you're not going to pay the regular fee or the regular price for Medicare. You're going to pay an additional amount, and the government doesn't like for us to say it's an extra tax or an extra or a penalty. The official name is Medicare Income Related Monthly Adjustment Amount.
Oh, okay.
It sounds kind of nice, but it costs money, so it's not too nice. And it could cost as much as an additional $487 on your Part D premium,
Okay.
and $91 on your Part D premium for your prescription drugs. That's an additional amount on top of the standard fee, which I think in 2026 is $202.90. So you're looking at a much higher premium than what everybody else pays for Medicare. And the reason you're paying that is because 2 years ago, on your tax return, your income was above a certain amount.
Okay. Yeah, and that adds up at the end of the year. I mean,
Yes.
people are, and if you can avoid that,
Yeah,
That-
and I say up to because kind of like the tax rates, they go up the more
Yeah.
income you have. The same with this penalty. It starts lower and then it goes all the way up to $487.
wow. So, what are some ways that we can help people reduce that?
Well,
So
number
let-
one, you can appeal it.
Okay.
If there's if you have a legitimate reason to appeal it, there is a way to appeal it. So that's possible, especially if your income from 2 years ago is not the same,
Okay.
or you went through divorce, or you got married, or there was a death in the family, or something major happened, or you're not earning the same. Those are reasons you can appeal it. Now, we're tax strategists, so we know that we can reduce taxable income, so
Yes.
we can affect IRMA as well. Even if you're above those incomes, those thresholds where you are paying for IRMA, there is a way to reduce that. And along with that, a lot of people have. This article talks about RMDs,
Correct.
and what are RMDs? Required minimum distributions.
The government makes you take
Right. So
distributions.
they don't make you take them, but if you don't take them, you're gonna pay 50% tax on top of the amount that you should have taken.
Wow.
So, in other words, they are making you take them. But they say, oh, you have a choice. You don't have to. You're just gonna pay more because you didn't take them.
Yeah.
So,
Just like
I
everything
love
else.
how they word things, right?
Yeah, I mean, that's the way our government works, man. But like in this article,
What did Ronald Reagan say? The most dangerous words in the English language are, "I'm from the government. I'm here to help."
yeah, there's always a catch to that. Oh, someone pays for it, no matter what. Yeah,
Exactly.
and you mentioned about the tax strategies, and I know that. So let's say if somebody is making a decent amount of money, already hitting those thresholds, there's options for them, right? Where we can help reduce that for them.
Yes. There's several options. I want to go back to the RMDs because
Okay.
you worked, or the people who are listening, they worked for 20, 30, 40 years somewhere. They put away money for retirement, and you built up a nest egg, and now you have $1 million, $2 million, $3 million in your 401k. So you figured, I'm fine. I can retire.
Yeah.
I can enjoy my life. And spend some time with my wife, with my family, take those vacations I always wanted to take, do the things I wanted to do before I didn't get a chance because I didn't have the time. And now you find out that you have RMDs, you have to take the money, and now you might have to pay IRMA because of those RMDs. Or you say, well, I heard about Roth conversions,
Yes.
so maybe I should convert my money to a Roth so it won't be taxable anymore. But if you make the conversion,
So tax it.
then your income was much higher, and now you're subject to IRMA again. So it feels like you're trapped.
Yeah. Yeah, and that's one of the things I wanted to talk about too, because I know we have another news article here, and talking about Roth conversions, and that can help, of course, save tens of thousands of dollars, if not hundreds of thousands of dollars for some clients, and also with our helps with RMDs as well, but there are ways that where you can reduce that tax hit when converting to Roth.
Oh, absolutely. We have strategies that where we can reduce the taxes during the conversion process. Now, at any time you could do a conversion yourself. You say, "Can I do this myself?" Of course you can.
Yeah.
But what's the problem? You're gonna pay taxes on the full amount.
Yes.
And we have ways to reduce that and save you a lot of money on taxes, and then save you taxes in the future because you're not gonna pay taxes on that money anymore because it's a Roth account.
Yeah.
RMDs are gone. You don't have to worry about RMDs. And the other, I say the things that you don't see coming are the ones that get you. I think the other elephant in the room is your beneficiaries.
Yeah, that's true.
If you pass away and you have this big amount of qualified money, which is, when I say qualified, it's money that's yet to be taxed, and then you pass away, if your beneficiaries is not your spouse, then they have to spend the money within 10 years.
Yes.
And they might not need the money or not want the money. And then the other thing that could happen is taxes could go up. Who decides that? Well, the government decides what the tax rates are. I know we're representative republic. We're supposed to have representatives that look after our best interests.
Yes.
But if we look at the national debt, I ask people, based on that, Social Security, having issues, Medicare having issues, and I ask people, do you think taxes are gonna go down? Do you think they stay the same, or you think they're gonna go up?
Yeah. Well, the scary thing is that you just don't know, but odds are it's going to go up. I mean, we had some tax cuts recently with the new Trump administration, but that can change very quick.
Yes. And now you have, so I tell people, yes, you have $2 million on paper on your 401k, but do you really have $2 million? Because you have a partner, a silent partner, his name is Uncle Sam, who gets a cut.
Oh, yeah. He wants his cut.
And he wants his cut. And he didn't have to work for it. You did.
Yeah.
For 30, 40 years. And it also could affect your kids.
Yeah.
Let's say you don't need the money. I want to leave it for my kids. Well, you're leaving it, a big chunk of it, for Uncle Sam as well.
Yeah.
So we can help with that as well.
Yeah, and the good thing is, I mean, yes, that is true, but there are options out there where people can use. The problem is you don't know, right?
Yeah.
A lot of people don't know. That's why it's very important to meet with a tax strategist like ourselves, and of course your financial advisor as well. But a lot of financial advisors, yes, they know all the proper vehicles and what to do, but when it comes to taxes, I mean, it's just one of those things. Well, sorry, this is the way it is, but in most cases, that's not the case. And we've seen it before.
Exactly. Yeah, and we have some really good relationships with some financial advisors, that understand the problem, and when we work together with them, we're able to get better results for the client.
Yeah.
But we're not always able to work together with all financial advisors.
Yeah.
Or other professions, because sometimes they might look at it as like a competition.
Yeah.
But we're not really in competition. Where we can collaborate, work together, we can get a better result for the client.
And to have an open mind, a lot of people don't have open minds when it comes to that. Like I mentioned in our last podcast with Lauren, is some of our biggest referral partners are financial advisors. And our goal is to make sure that number one, their client's happy. Number two is make sure that they're the hero, right? We're happy being in the background and working out the numbers for them. But at the end of the day, it's still their client.
Yeah.
Yeah.
And you know, we do what we do, and then they do what they do,
Yeah. Yeah.
and what they're good at, and we can do what we're good at.
Correct.
So it helps everybody because you know, the name of the podcast is money
Mindset.
the money mindset. So everything's related.
Yes.
Whether it's RMDs, whether it's IRMA, whether it's your retirement account, whether it's taxes, it all affects your bottom line, your pocket. So the financial advisor is related, the CPA is related,
Correct.
the tax strategist is related to the issue, and if we can work together, the better for the client.
Yeah, I mean, at the end of the day, it's the client. Now, imagine you're able to convert to a Roth without paying any taxes at all. I mean, that's the beauty of what
That's
we
the
do.
goal.
You know, and it's possible. It's just you got to find the right strategist. Hopefully, it's us. But if it's not us, at least somebody in your corner that's gonna fight for you and to show you these things, help you put everything into place. But it is possible. Like, what is the average that you have seen? That we have saved our clients on converting to a Roth. Whether it be, I know a lot of people, if you're working at your place of employment, they're not gonna let you touch your 401k or anything like that. But someone who's left a previous job to move to somebody else, another company, they have access to that money, or someone who is retired or just retiring.
Right. So there's different what they call qualifying events.
Okay.
And you mentioned some of them. You left your job. You're no longer working there. Then that's a qualifying event where we can do a conversion to a Roth and save you on taxes. The other one is you retire, you stop working.
Yeah.
Then you can do it. You're over 59 and a half, you stop working, or even under 59 and a half, you're no longer working there. So separation from service is another qualifying event.
Yes.
So retirement, separation from service. Some plans allow for what's called in-service distributions. Most do not.
Yeah.
Some do. So if you're still working there, is it possible? It depends. It might be possible to do a Roth conversion while you're still working. Most of the time it's not possible because it's up to the plan administrator. But sometimes it is possible, and if it is, then you can take advantage of that.
Yeah.
So there's, you know.
So what's the minimum that we can work with in regards to the minimum in the accounts, the IRAs or 401ks?
Right. So I would say, because in any decision you make or anything you do, there's always a cost.
Yes.
And it has to be worth the price, right?
Yes.
If the reason you buy things, whether it's a car or something else, or you pay for something, is because you're gonna get more from it than what you paid for it. That's the value of that whatever you're buying. So it has to be worth it has to have enough value to pay that cost. And by the way, there's cost in everything. In your 401k, you're paying cost. In
Yes.
your mutual funds, you're paying cost. So you might hear people online or social media or different places talk about free. And I always tell people there's no such thing as something for nothing.
Yeah.
Because every time I get something for nothing, that means somebody else has to give something for nothing. So that's why I don't like to use the word free, or other words that people throw around, like guarantees, for example.
Yeah.
There's no guarantees in life. That's life. There's only guarantors, right? So you gotta work with people that are gonna stand behind what they said they were gonna do, because they're the guarantors.
Yeah.
But going back to the making sense, I would say around 500,000 on your 401k. It's where it makes sense to
do that.
yes, because you're gonna get a large benefit for the price that you're gonna pay to do the conversion. Now, we figured out a way how to do it where you can still pay that price, but it's not out of your pocket. So
Yeah, that's the beautiful thing
yeah,
about
that's
it.
the beautiful thing. But there is we're not gonna say it's free. There is a price,
Yeah.
but what you pay is worth what you're gonna get.
Well, the whole idea is just to reduce it as much as possible.
Right.
Engineer the strategy as much as possible to make it.
Yes. Where what would be the alternative? If I have $2 million in my 401k, and even at tax rates where they're at today, and let's say I'm gonna pay an effective tax rate of 22% on that 2 million, you're still looking at like $400,000 in taxes
Yeah.
over, as you deplete that $2 million. So that's a big price to pay for keeping it as a 401k, as an IRA,
Yeah.
versus paying maybe a much smaller price and now it's tax free. That's the key.
Yeah. I know some people, usually the way it happens is they do a conversion over a period of time, 7-10 years, whatever, right, to a period of time. But we have ways where we can do big chunks at a time, moving that money over, reducing that tax hit still, and then converting those funds into a tax-free
Yes.
retirement account.
The most common way people do it is, like you said, over 7 years or longer, and which is fine. You can do it that way.
It's kind of hard if
Well,
you don't have access to it, and then you retire. You can't wait 7 years to move that money over.
here's the
In most cases.
yes. Every time you convert IRA to Roth, normally, and I say normally because there's exceptions to every rule, but normally you have to wait 5 years to access that money. So if you're taking 7 years or 9 years to move that $2 million out of your IRA into a Roth, every time you move a small chunk, you have to wait 5 years on that chunk before you can access that money. So that's one of the drawbacks. The other drawback is that if it's going to take 7 years, 9 years, I don't know what taxes are going to be at in 7 years.
Yeah.
I know what they're at right now, and I know they're historically very low.
Do it now.
Yeah. So you have to take advantage of the circumstances,
Yeah.
because we don't know what's going to happen. We know where we're at right now. We can't know the future. But having talked about, do you think taxes are going to go down, stay the same, or go up? So what are you waiting for taxes to go up?
Yeah. And that's the thing. And not only taxes, like you mentioned earlier about fees, and we know mutual funds have a lot of fees, and 401k has a lot of fees. That's why, and ultimately, if you're a financial advisor and it's your client, you can do whatever you want with the client. But, that's why a lot of times we look at indexing. Some companies have very, very low fees when it comes to indexing annuity companies and stuff like that. But, that's more on whatever the client wants to do.
Yeah.
Of course, at retirement age, you really don't want personally, don't want your money in a lot of risk. You worked hard for that money. So there's different options for that too.
Yeah, absolutely. And it could be the option of the client and the financial advisor, like
Yeah.
you mentioned. So the advisor can still do, the financial advisor can still do what they do, and we can save you on the tax side.
Yeah.
So
So
there's a lot of opportunity.
how would it look? Let's say a financial advisor comes to us and say, I got this client, that perfect scenario for us to help them. How does it look in reference to how they're seeing it, the financial advisors? How can we help the financial advisor and the client But of course, you want the financial advisor to know that they're still going to be in control. How does that work? What's that process look like?
Well, I think the very first thing is it starts with the client. The client has to be wanting to make a Roth conversion, right? They see the issue, they see the problem, they say, I got $2 million on paper, but I really don't have $2 million because Uncle Sam has a cut.
Yes.
And I don't want to take these RMDs, or I don't want to be forced to take the RMDs. And I'm worried when I pass away, what am I going to leave my kids or my spouse?
Their heirs, yeah.
So if that's you and you want help, then it starts with having a conversation. And in that conversation, explaining the options that you have and getting your financial advisor involved if he's open to getting involved in something like this. And like you said, the financial advisor still is in control of the investments and how you invest that money, whether it's very conservative or aggressive because the client is aggressive or the client is conservative. It's still your money, and you're going to invest it as you would like to invest it along with your financial advisor. What we did is it's still the same investments. We just changed the way it's taxed.
Yes, yeah.
From taxable to non-taxable. From forcing you to take RMDs to not having to worry about RMDs. From you worried about how much your kids are going to get and that they have to spend it in 10 years to not having to worry about that. And they get the full balance.
That's another thing. So if they have their money for 401k IRA, they're gonna pay taxes on that money. I know index universal life policies, IULs, that's taken care of. You don't have to be worried about that. So is it the same thing for a Roth as well?
Can you repeat the question?
So like when it comes to the Roth, leaving it to their heirs, what's the tax implications to their heirs?
Oh, I see. Okay. Well, the tax implications is when it used to be that when somebody inherited an IRA, they didn't have to spend it.
Okay.
Now, if you have an IRA, a 401k, and it's a non-spousal beneficiary, your kids,
Yes.
or somebody else that's not your spouse, then pretty much under the new rules, they have to spend that money within 10 years, whether they want to or not. They're
Wow.
required. So it's gonna affect them because maybe they don't need the money, or they want to leave the money for retirement or put it in their own IRA, but they can't because of the new rule. Well, if it's a Roth, you don't have to worry about that.
Wow.
They could cash it out if they want to completely. They don't have to spend it. They could spend it. They could do whatever they want with the Roth. It's not subject to those rules. So
Okay.
that's the big difference.
And they won't pay taxes on that, or would they have to pay taxes on that?
No, it's
It's
a
already taken
Roth.
care of.
Yeah.
Man, that's beautiful. That's
Yeah.
awesome.
Yeah.
So converting it, and the way we do it, the way we can help you reduce the tax hit, and then the heirs, not to worry about that either.
When somebody understands the benefit of going from IRA to Roth, they want to do it. The reason most people do not do the conversion is why? Because taxes.
Yeah.
They don't want to pay this big bill. Neither would I. I have $2 million. If I convert these $2 million, then I'm gonna pay IRMA. I'm gonna go up on my tax bracket. I got all these other things to worry about. So, what do most people do? Well, I don't want to go through that pain.
Yes.
The same reason most people don't want to go to the dentist is because it's
I
not
know.
it's not a pleasurable experience most of the time.
Yeah.
So they say, well, I'm not going to do it because I don't have to do it and go through the pain.
Yeah.
But what they don't realize is that they may be creating a bigger problem by
The
not
pain is
doing
coming,
anything
but
about it.
yeah, the pain is coming, but you're just prolonging that down the line.
Or it might be worse,
It might be worse. Yeah.
because what if taxes do go up?
yeah.
Or what if the other thing we don't have control is what the old saying, death and taxes. The other one is death. What happens if you pass away?
Yeah.
And this $2 million that this is for my kids. Well, now they don't really have $2 million either.
No, they don't.
So, uh, so like I said, most people that understand the benefits of having a Roth would want to have one, but the big hurdle is taxes, and that's where we come in.
Yes.
Yeah. And the other thing we didn't talk about is that if you earn more than I forgot what the amount is, they change it year to year, and it's a different amount if you're single or married. I think it's a little bit over 200,000 if you're married. If you earn more than that amount, then you can't even open a Roth IRA.
That's true.
So
yes.
I wanted a Roth, but I couldn't because I was earning too much money. So I have an IRA because I didn't have a choice. Well, now you have a choice. We can do the conversion to a Roth. They call that a backdoor Roth.
Yeah.
So you can still get your Roth. It's just we have to be creative about it.
Yeah, and so we can help you guys. For sure, we can help you on doing that, converting to a Roth and reducing that tax hit. Just reach out to us. We'll be glad to help you with that. It brings us joy, just helping people out. Doing that. It's just amazing, and to be part. And like you mentioned before, taxes are a huge part of your your overall financial planning.
Right.
At the end of the day.
I would call it holistic planning. And the other thing that we've been getting a lot of calls when it comes to Roth conversions lately.
Yeah.
And I think it's because more people are becoming more and more informed of these issues, and they know that there is a problem, because all you have to go on Google and type IRMA, type RMDs, type Roth conversion, or AI. People use AI for different things, so people are becoming more and more informed.
Yes.
So they understand that there is an issue. So we've been getting a lot more calls and a lot more people wanting to talk about that. And it's also because, we got this demographic group of people that are called baby boomers they're
ready to retire, man.
Yeah, and where as Americans, where most people are older, a large percentage of the population is that population that is going into retirement.
Yeah.
And they worked for 30-40 years and put money away. They were not very lavish. They didn't have these lifestyles of the rich and famous, but they were ordinary blue collar workers or white collar, but they were not earning, they were not super wealthy, but they were putting money away, working hard, and now they accumulated millions of dollars. But with that accumulation, what they didn't realize is that they were also accumulating taxes.
Yes, and that's the thing,
Yeah.
and people get real excited because you have $1 million, this and that, but in reality, that's not the case. So if there's a way to eliminate that, why not do it? And the way we do it, right, and we're drastically reducing that hit.
Yeah, absolutely. I mean, when I talk to these people that are hardworking, they have regular family. They're not business owners. They didn't have an exorbitant lifestyle. They were just regular people who work hard and put money away, and weren't living above their means. And we want to help them because they're just regular folk.
Yes.
And now nobody told them that most of the time some of them believe that money's not taxable. and they have no idea.
Yeah. No, we see that a lot. That a lot of. I mean, everybody's busy, working hard, accumulating their saving for retirement, paying for taking care of their families. So, they know there's issues there, but they don't either have the time, or is this one of those things they put in the back burner? But that's where we come in.
Yeah.
And we try to help our clients as much as possible do that. But so reach out, guys. I mean, reach out. We're excited and we're ready to help you guys to help you reduce the tax hit. I mean, that's huge. That's huge.
Yeah. And I know we talked a lot about different things that kind of correlate with each other, but I'm looking at some of the other articles you have here. A 63-year-old's 600,000 401k Roth conversion plan saves tens of thousands in taxes before RMDs hit. So this is an article about how much money you can save by just by doing a conversion. That doesn't include any strategies
Yeah.
that you would put in place to save you on top of that
Exactly.
for the conversion.
So yeah, people are going to save, but
Thank you.
what we're saying here is that we can really help them save doing this. And not only to mention, guys, also whenever we don't talk about the growth. So all that money, yeah, you're converted. We're taking care of the taxes, but that money's still growing. It's still accumulating, especially if you don't have to take distributions if you don't want to.
Right.
That money's just accumulating.
Yeah,
and growing for
and
you.
even if you are, and this is where if you got a good financial advisor, even if you are taking distribution, you're still earning interest on that money.
Yes. Yeah, it's a beautiful thing.
Yeah,
It's a great thing.
And we work with some of the best financial advisors
Yes, we do.
around.
Yeah, so like we mentioned earlier, we're just here to help financial advisors, and like I mentioned earlier, our biggest referral partners are financial advisors and CPAs as well,
Yeah.
and that's what we do.
What's
Yeah.
this one on, Jaime? Despite progress, high earners still leave state at high rates.
Well, people are leaving New York.
Oh,
I mean, you raise taxes, what happens? I mean, granted, I mean it's New York, and there's a lot of stuff going on there. A lot of people that live there. But it just seems people are getting ahead of themselves, and they're moving on out. And we've been seeing that mass exodus happening, moving to other states because of the taxes. It's hard to do business there. Well, what do you think about that?
well, it might be a sign of things to come, unfortunately. And you got states that, and it goes back to there's no such thing as something for nothing.
Yeah.
When you have programs that are going to cost millions and millions of dollars, that money's got to come from somewhere.
Yeah.
And unfortunately, if people have a choice between paying this much in taxes versus paying much less, and you can move to that state, then most people would say, well, I'm gonna go ahead and move.
Yeah.
My kids are grown, I'm no longer working here, so I don't have to live here. And they vote with their feet.
Yeah. Why not? I mean,
I can't blame them.
No, who would? I mean, we're here in Texas, and Texas is booming because people are moving down here in droves, simply for that, and not only for our Texas weather, which is cold one day and hot the next, but no, that's a whole different subject. But no, yeah, I mean, people. I mean, it's sort of like common sense, man. I don't know. I mean, who, especially business owners, who in their right mind is gonna want to stay somewhere where they're gonna be? I don't know what the percentage is in New York, but let's say take half of your earnings. I mean, this doesn't make sense. I mean, they're going to move somewhere else because they can still operate, still provide a service to their clients, but pay less taxes. I mean, it only makes sense to do that. I don't know why that way of thinking is
So this is specifically about New York or other states as well?
This is New York, but like I say, it goes for other states. I know a lot of our clients, which are happy because we get the same money from California, but there's still state taxes that we can't help with that. that situation. But you know, there we get a lot. We have a lot of California clients, so
Mm-hmm.
you know,
And I mean, I love California as a to visit, right?
yeah, it's beautiful weather.
I don't know if I could live there because of the taxes,
Yeah,
and but it is unfortunate that just by living there, you're gonna pay more.
yeah,
There is a cost, right, for everything, like I mentioned before, and if you're gonna have big social programs, and I'm not here to say whether those social programs
Yeah.
are right or wrong, but there's a cost for that social program.
there's only so much you can do. I
Yeah.
think, but yeah, you're right. I mean, it's not a political thing. It's a more of a common sense thing. If you can't
Yeah.
afford it, and now, granted, there's people that want to pay the taxes. Power to you. That's awesome. That's
Yeah.
great. But a lot of people, a lot of business. I think it hurts a lot of states because the businesses do flee.
Yeah, I mean, I remember I learned algebra a long time ago, and you got an equal sign, and you got numbers on this side of the equation, and you got numbers on this side of the equation. And the rule in algebra is if you subtract from this side, you got to subtract it from the other side. If you add from to this side, you got to add to the other side. Whatever you do on one side, you do to the other.
Yeah.
So, otherwise, the equal sign doesn't work.
It doesn't work.
So whatever you did to one side, you had to do to the other side. So if the price of this goes up, well, this is gonna go up as well. So that's the way. I mean, it's just common sense, like you said. It's
Yeah.
not rocket science.
You know, and going back to taxes or high state taxes, we have a lot of clients that are W-2s, and we help them reduce their federal income tax for sure. But you know, a lot of people don't realize there's what's called excessive business losses
Oh.
when it comes to W-2 active income, W-2 workers. Can you explain a little bit more what that EBOs, what it is, and the totals and amounts and stuff like that?
Yeah, that has to do with non-business income.
Okay.
So not just W-2 income, but it could be interest. It could be other forms of income, royalties,
Correct.
non-business income, and we can reduce that up to that limitation that the IRS has imposed. And for this year, for somebody who's married, it's 512.
Okay.
And for a single person that files single is half of that, 256.
Okay.
Now, those are for. We have strategies that
Could
are
still go-
affected by EBL. We have other strategies that are not affected by EBL. So we, despite that limitation, and you say, well, I'm a W-2 earner and I earn $2 million or I earn $1 million, and you can only reduce it by 512. No, we can reduce it by more. Is just the limitation for some of the strategies that we use.
Yeah.
Other strategies are not affected by that limitation. But if you do happen to go over that limitation, you don't lose that that loss. It carries over to
It
the
carries over
following
to the
year.
next year.
So
Like-
if we implement a strategy that's going to reduce your income by, let's say, 800,000, and the limitation is 512, then what is it?
300.
288.
Yeah.
The 288,000 will be carried as a loss next year, and you can use 80% of that the following year, and you don't lose the other 20. It carries
It
to
carries
the
on.
following year as well. So that might be the best way to go, because then you get to use that, and next year the EBL, excessive business loss, will be higher a little bit. It's going to go up by the inflation rate. So next year it could be 524
Okay.
plus your 288,000 of. So now you have a much higher ceiling,
Yeah.
and this is where that money mindset comes into play. We get creative with the numbers.
Yeah.
We think, as the old saying goes, outside the box, And I like to use that metaphor of the box in another way is that most CPAs, if this is the box that that's the IRS code, most CPAs are right there in the middle.
Yes.
Now,
Too conservative.
yes, we might be right here, not all the way to the edge, but if there's something as the letter of the law and the what is it called, the heart of the law, or what is it called, the intent, or the
Yeah.
I forgot what it is
It's all
called,
right.
but we're not gonna go just by the letter of the law. We might stretch that box out a little bit. We're not gonna be all the way to the very edge.
Yeah.
But if you're allowed to do something, and there's exceptions to every rule, and your CPA is gonna say, we're not gonna take the exception. We're just gonna follow the letter to the law, even though this is allowed. We're not
Yeah.
gonna do it. Then I would say, who is that hurting?
It's the client.
It's not hurting the CPA. It's hurting the client. So
Yeah, I use a metaphor like engineering. Like when you're doing engineering, like I mentioned last podcast, I used to do engineering work for a local power company. You engineer it to the T, where this is how much I can maximize, right? Or this is how much I can't go past this line, but this is how much I can maximize. That's in you're engineering your financial plan, your tax
yeah,
strategies.
you're not over engineering.
Not correct. Or you're not under engineering. I don't want to say the lazy way, but I'm saying the more conservative. Well, no, let's not look at that.
Yeah, like the suspension of a car. You got the chocks, you got the struts, and you say, well, I'm gonna add this backup in case the shocks go, and they fail. Well, that's great, one backup. But then you say, well, I'm gonna add another backup to that backup. I would say that's over engineering.
That's over engineering. You're overdoing it, and it costs you money.
Yes.
At the end of the day, it's going to cost you a lot of, like you said, not the CPA, but it's going to cost the business. And like we mentioned, like tax code or the taxes is, and if you really look at it, it's designed to create wealth for especially for the business owner. It's a code. You got to look for those. You got to look not a code. I'm sorry. It's a law and codes, right?
Technically, what is
But you got to look for those, and you got to sort of push the button. And the good thing, all of our strategies have audit protection, so we'll defend our strategies too.
Yeah, I mean, these so-called loopholes are not loopholes because they're actually in the law.
Yeah.
It's just that we're utilizing them and somebody else is not utilizing them. They're just utilizing the middle part. All this is still part of the law. We're not outside the law, but
Yeah.
we might be more off center.
We explore, man.
Yeah. We're not strictly in the middle because who is that hurting?
Yeah.
It's not hurting Uncle Sam. It's not hurting the CPA. And
It's hurting you.
and CPAs that are a little bit not as conservative are some of our biggest referral partners as
Yeah.
well.
Exactly.
Because what the CPA wants to know and what the client wants to know is this defendable? If the IRS questions it, can we defend it? And yes, we can. Here's the code that
Yes.
allows us to implement this. Oh, okay. Then the client would be fine and the CPA would be fine. But if the CPA says, well, that's not the way I do things, I do them this way,
We can.
then I can't change that CPA. But the way
The
things
client
change
can.
is progressively, because if the client hurts the CPA's pocket, then that CPA might become more open to making a change and saying, okay, what is that rule? Let me see. Okay, here it's in the code. Okay, how do you defend it this way? Okay, now I get it. Then that CPA is
Yeah.
somebody we can work with.
Yeah, and most of our CPA partners, I mean, they have tons of clients, and they don't have the time to be searching for all these strategies. Now, once we present it to them, like you mentioned, they
Yeah.
love it.
Exactly.
But it's just the time for them to do that.
Well, let's think about it. We're creatures of habit, right? And you know, when I'm at church, I tell people, you guys are creatures of habit. And they say, no, we're not. Okay. Let me see, where are you parked? The same place you parked last week. And the week before that. Where are you sitting? Oh, you're sitting in the same seat that you sat the week before and the week before that. And when somebody new came in and sat in your spot, you say, oh, that's my spot. What are you doing in my spot?
Yeah.
Because we don't like change. Because we like things the way we like them.
Exactly.
And the CPA likes things the way he likes them. But this world is not static. This world is constantly changing.
Yeah.
So we have to adapt. And if you're happy with the status quo, if you're happy with the way things are, if you're satisfied, then you're not gonna change.
Yeah.
You're not gonna be uncomfortable enough to do something about it.
Yeah.
So
Take that first step.
yeah, we're talking to people that are uncomfortable paying the IRS 100,000, 200,000, 50,000, or maybe you don't pay those amounts, but you have $2 million in your 401k. Well, guess what? Over your lifetime, if you spend those $2 million, you're gonna pay the IRS a big chunk of that $2 million. So you don't really have $2 million. If you're okay with that, then that's fine.
Yeah, it's good.
I can't help. But if you're not okay with it, and you want to do something about it,
We can help.
we can help.
Yeah. And then going back to the non-business income with the EBLs, at the end of the day, let's say someone's earning $800,000 a year, would you rather pay taxes on 288 like you say, or would you rather pay taxes or I'm sorry, on the 800,000 or just the 288,000? I mean, it makes total sense to.
It kind of goes back to what's going on here in New York. Who are the people that are leaving? The ones that are uncomfortable paying all those taxes.
Yeah.
The ones that are comfortable paying all those taxes, well, they don't leave. They don't leave. They stay.
Yes.
And that's their choice. I can't change those people.
Yeah, it's a choice,
Yeah,
and people have that choice. And I mean, and thank God, like you mentioned earlier, like we were a republic, right? A collection of states, and you have that privilege. We have that privilege to move to different states and different situations, and and that's the beauty of this country. But that's another thing here, So supposedly the IRS is smaller. I'm reading another article.
You know what?
What do you think about that?
I think they are smaller, but it might not be a good thing. You say, well, they might be smaller in personnel, but I don't think they're smaller in power.
Yeah.
Or in reach, right? And because of our job, sometimes I have to make a call and talk to somebody at the IRS because.
Like some water? Or you got some?
I still have some, thank you. So I pick up the phone and I call them. And I'm calling early, 8 in the morning. I figured I can get through to somebody.
Yeah.
And I get a message that says, due to high call volume, and beep, due to high call volume.
Yeah, so it's
At this time, we cannot take your call. Call back at another time or another day. And bye-bye. I'm like, what's going on here?
I know.
So do they have less people? Probably. I can't even talk to somebody. I have to call them at 7 in the morning so I can talk to somebody.
And yeah, I know that because we have called them, and matter of fact, we talked about that a couple of days ago. Like, man, I can't a client had a question, so we were calling on behalf of the client, but we couldn't
We couldn't get
we
through.
couldn't get through. I mean, it's, and I wonder, does that mean that is there a lower chance to get audited, or what, in your opinion, what do you think about that?
Well, I don't think so.
I have heard that if people that file on time, all that, those are the ones that tend to get. I don't know. I mean, it's just that's what I hear. They tend to get audited more if you file right on time. Is that correct? Or what have you heard, or what's your opinion on that?
Well, you hear a lot of things, right?
We hear a lot of things.
I have heard that. I think the best way to find out is if any of you out there that are listening have insiders. Well, if you talk to somebody that used to work for the IRS or well, I wouldn't say don't talk to somebody that is working. I don't know if they can tell you anything, but somebody that used to work, and I'm sure they might be able to tell you public information and stuff like that. The IRS is, what do they do? Do they produce something? Do they make a product, a service, or no? They collect money. That's their job. So that's how they keep the organization
Yeah.
going.
Yeah.
The entity that is the IRS. So they have to collect money, and so that's the reason I don't think there would be less audits.
Yeah, I don't think so either. I mean, I
There
think
might be less other stuff like people answering the
Yeah.
phone.
I think they're experts at what they do. When they see something, a red flag or something like that, I think if you're gonna get audited, you're gonna get audited, right?
And you could file a perfect return with no mistakes. And I think some people get I believe the system has some people that are audited at random.
Yeah.
So there's no magic formula to never get audited. And when people hear the word audit, they automatically think the worst. I have to go in front of somebody. Most of the time, most audits are by mail. They send you a letter and say, "Hey, we're missing this form," or "We have a question about this," or it normally doesn't go to the degree that you have to go in person
Yeah.
and take an attorney or representation and talk to the IRS. Most of the time, it's going to be something in the mail, and they have a question about a specific thing. So you answer the letter or the concern, or it might be a mistake in their part. They're human at the IRS as well. One of our clients recently got a letter, and actually it was for something their CPA from a previous year had done. It didn't have anything to do with our strategy. And I read the letter. It says the amount on line 7 of your 1040, which is line 7 is capital gains, says this much, and you didn't submit a schedule schedule D for capital gains. So I look at it's 1040. Line 7 is 0. Line 8 matches the amount that's on the letter, not line 7, which is not capital gains.
Mm.
It was money from an S corp, from a corporation that his wife owns. So, and they declared it. They have the K1 in there. So the IRS made a mistake. They're saying that amount belongs in capital gains, not in income from a corporation. And the client didn't make a mistake. The CPA didn't make a mistake. The IRS is making a mistake. And that's actually the call I was calling the IRS about initially. And then I read the letter again. And I thought it had to do something with our strategy, and nothing to do with their strategy. It had something to do from the previous year. But it says on your return that, if they put the date 2025. Well, they filed in 25, but it was for 24 income. So that's where I made the mistake. And then when I read it again, I was like, wait a minute. This is not...
Well, that was someone... Yeah. That was a previous tax person.
But my point is that the IRS makes mistakes all the time.
Yeah.
So when you get a letter from the IRS, it's not It's not the end of the world. It's not panic time. And an audit, which anybody can go through, even if you file a perfect return, it doesn't have to rise to that level where you're gonna have to hire representation. Most of the time, it's on paper, and most of the time it's something simple.
Well, I think a lot of people get in trouble when they start deducting things they're not supposed to deduct. I mean, and we've been taught, well, not us. I'm talking in general. People in general have been taught, well, you can deduct this, deduct that, deduct this. But what I like about our system, our structure, what we do, a lot of our strategies are huge deductions where you don't have to deduct everything, little things, because our strategies take care of the big chunks of the tax
Yes.
hit. And that it makes it cleaner. It's cleaner in the eyes for the client and of course the IRS. That's what I
Yeah,
like about
because
it.
this
what we
big
do.
chunk, you can justify it with the code that we use. That's
Exactly.
actually inside the code, inside this square, the box. So it's very defendable. But this little stuff that a lot of people are doing, where they're deducting personal expenses as a
Mhm.
business expense, that's not
No.
allowed.
And then you
And a lot of people do it
yeah.
because they unfortunately they gotten away with it before, and I say unfortunately because not because they got away with it, but because it creates a pattern.
Yeah.
And it becomes, when you get a pattern, and going back to being creatures of habit, you think of it as acceptable. Oh, it's okay because I've done it 20 times before.
Yeah.
But on the 21st time, that's when you get in trouble. So, what you don't know can hurt you,
Yeah.
and habits can hurt you as well, if you have the wrong habits.
And even if they're legitimate expenses, I know we run into people where they say, well, my accountant said I have to go buy 2 more trucks or go and buy these trucks, which if you need them, do it, right? Or I got to buy this equipment or that equipment. But if you don't have to be doing that,
Well, yes, but the other, going back to that, you go buy a truck. It has to be for business use.
yeah,
It's going back to that division between personal and business, and we're talking now. We're not talking really about to the W-2, worker.
we're talking no business.
We're talking about business owners. So if you're listening and you say, wait a minute, you were talking about 401ks and W-2 workers and blue collar, and well, this doesn't really apply to you unless you have a business. And yes, you could buy the truck, and it's legitimate. If it's used for business. But you buy that same truck, and you say it's for business, but you're not using it for business, then technically
It's not.
it's not.
No, but like for someone that owns a fleet, it's a business expense.
Yeah.
I mean, legit. I mean, my point is, if you need the vehicle or need the equipment, buy
Yes.
it. But don't just buy it just for the deduction. There's
Well-
lots of expenses ways that we can show you how to
Well, what are you doing
reduce your
there?
tax burden.
What's going on there? Well, I'm buying it because I don't want to pay Uncle Sam. I'd rather buy, this vehicle that I don't need. But I got it because I don't want to pay Uncle Sam. I keep. Well, let's look at it. All right, you didn't want to pay Uncle Sam, $10,000 or $12,000, so you spent 60. Okay, does that make sense? No. And then, you got to write off the whole 60,000 because you're able to depreciate that whole vehicle in 1 year. Great, awesome. But now, what do you have? You're paying on the financing, unless you paid the whole 60. So you're paying interest on top of that. And what do you have? You have an asset that's dropping in value the moment you drove it out the parking lot.
Yeah.
So, are you really on the positive side or on the negative? Now, you could be on the positive. It's you need it for business. If you need it, great, buy
It
it.
was going to produce more money
Yeah.
for you.
But you bought the vehicle and you didn't need it. And you saved 10, but you spent 60 plus interest, and then now you got a truck that's losing value every year. what do you? Is that really an investment?
Yeah, it doesn't.
Is there better ways to do it? Maybe it should be the question.
Yeah, no, and it's funny, but we run into a lot of things. I know we had one client that their CPA told them that they're gonna have a huge capital gains hit. They had some developments, and he told them, well, you gotta sell this building, this building, this building to pay for their capital gains taxes. I mean, that's that. I mean, that's not.
I mean, I'm not saying that the CPA is wrong, right? I'm just saying that he doesn't have the same tools that we have because he's not in the same specialty that we are.
Yeah.
So I'm not gonna attack the CPA because he's trying to help from what he knows. Because there's a tax bill, right? A capital gains, and most people, when they have, especially when it comes to real estate, they're thinking, well, I have to buy another piece of real estate,
Yes.
so I won't have to pay
You
capital
roll it
gains.
in.
Yeah, I do an exchange. But what if you don't want to buy more real estate? You just want to sell and keep the money. Well, then you have to pay the capital gains, right? Unless you do a strategy that
We can do.
we can do to eliminate the capital gains. Now, is there a cost to the strategy? Yeah, of course there's a cost, but the cost is going to be less than your capital gains taxes.
Yeah.
So, would you rather pay the capital gains or pay a much lower amount and not pay the capital gains? And maybe buy an asset that actually going to produce income
Yeah.
instead of losing value every year. So, when I guess what we're gonna do is we're gonna stretch your mind with the possibilities,
Yes.
because just like the CPA, some of the people that are listening to us are still within that box, because you only know what you know. You don't know what you don't know.
Yeah.
So if you don't know, then you're still within that box that this is available. Well, how do you do that, Eddie? How do you do that, Jaime? Well, that's why you need to talk to us. We could spend hours and days just talking about how you do it. But do you really want to know how we do it? Or you want to save the money on the taxes?
Yeah, just the end result. Yeah.
If I go buy a car, I don't want to know how the suspension works and how the motor works. And I might be interested because I'm curious. But do I really want to become an automotive engineer and figure out all the, details
every little
and
detail.
every detail? It's a turbo engine. It's got 6 cylinders. So much cuvette, so much space, and then when
Yeah.
the cylinder explodes, it produces so much torque, and then the suspension is this type of suspension, and it's a sport. No, I don't need to know all that stuff.
Yeah, and
You're already busy.
you're already busy as it is. But the good news is that there's solutions for that.
Yeah.
I mean, man, that person's face was a smile, and that saying you don't have to do that unless you want to. And like it goes back to especially the real estate. It's like the way I say it, it's you're chasing your tail, right? Yeah, you're gonna make profit on one real estate deal.
Yeah.
And then, it goes to another, and they never see the money. I mean, at the end of the day, until they cash out, right? But
Well, I think sometimes we have certain expectations because we heard real estate is great, and real estate is great, but there's limitations to real estate, and real estate is not the end all to be
Yeah.
all, because if I have a lot of real estate, but if all my money's in real estate, and I have an emergency, how do I get that money out?
yeah, you can't.
I have to sell.
Yeah,
And if you need to sell right away,
that's another thing. Are you gonna have? Do you have a buyer that you're gonna be able to?
yeah, you're not gonna get the price that you want if you have to sell right away.
Yeah,
And so there is risk with real estate. So you have to understand the risk. You have to manage the risk.
yeah,
You have to. I like analogies like baseball. You have a baseball manager. What is the job of the baseball manager? He's not even called a coach in baseball. They call him managers. His job is to manage the game. He says, okay, that guy's arm is tired, and based on the numbers and history, and specifically him and against this hitter, and in this field that we're playing in against the Colorado Rockies at this altitude. It makes sense that I switch him at this time, because I'm taking less of a risk by doing it now than waiting till next inning. So he's managing the risk. There's always risk in everything, but you can manage those risks.
Yeah.
We drive a car every day. We don't, unless you say I don't want to take any risk, then stay home, don't drive.
Yeah.
But if you have to get to work, what are you gonna do? You're gonna manage. Unless you're in New York, right? You could take the subway, I guess, but there's risks there too.
Yeah, unfortunately.
So you get in your car, you put on your seatbelt, you follow the speed limit, you give the car in front of you distance, you check your mirrors, you use your signal lights. Those are all risk management. Same thing here. We manage the risk. So what's your risk if you don't do anything? That you're gonna pay most of your money to taxes.
Yeah. No, real estate is another animal, man. You need to get a hold of, and they say manage, because you got long-term rentals, short-term rentals. You got to deal with tenants.
Yeah, and you're gonna manage the property yourself, and if you're not, you're gonna have to pay a management company.
Yeah.
You have to create LLCs. If you don't, then you get sued.
Yeah.
Then, they could go after your personal assets. You got all kinds of.
Yeah. No, I think real estate, especially
Is it active income, passive income?
talking about long-term rentals, I think it's for somebody who has tons of cash that they want to invest in something and sell it at a later date. I mean, that's my personal.
Yeah, and I'm not saying real estate is not for you.
Yeah.
As a matter of fact, some of our strategies use real estate.
Correct.
I'm just saying, you have to understand what you're getting into.
Yeah.
It's like if you're gonna get married. Before you get married, you have to know who you're getting married to, and she has to know who she's marrying as well.
And I think, and that's what I like. What we do too is we're we're advisor for the client, and they can ask us questions.
Well, in a way, we're getting married. When a client comes in, we're gonna create a relationship, like you said, so we can get to know what your needs are, because maybe you do want real estate, or maybe you have real estate and you don't want it no more. Like this gentleman, he has real estate.
Yeah.
So we're creating that relationship.
Yeah.
Because he has another relationship with the CPA. And his CPA advised him to do this. Now he has a new relationship, and we're making a different suggestion that's going to reduce what he has to pay in taxes. And now he doesn't have to sell the other building just to pay for the capital gains of the other one. Because if he sells this other building to pay for the capital gains of the other one, now he has capital gains in the one he just sold.
Well, he's going to...
He was going to buy something else.
Yes. So, it was going to be a combination of a few different properties to roll over, it works, like you say. But if you can avoid that...
Well, the question is there a better way?
Yeah.
That gets the job done with what I want to do.
Yeah.
Because if he does want more real estate, then great, go for it.
Go for it.
But in this case, he doesn't. He wants to keep that building. He doesn't want to have to sell, because that building is producing income for him, right?
Exactly.
And he says, I like the income that I'm getting from here. Well, you don't have to give it up just to pay the taxes on the other one.
That's what I'm saying. I mean, it comes back to engineering the strategy, or the strategies, engineering your, and like we like to do, we forecast, right? It's a proactive way of thinking, and start planning for the next years and the next years and the next years. And the whole idea is to keep more money in your pocket at the end of the day. And we all pay taxes. There's nothing, we're not saying paying taxes is wrong. I'm saying we all pay taxes. Every day we're paying taxes, right?
Yeah.
But what we've seen, and what we love about it is that especially the business owners not only business owners, but W-2s, they end up spending more money in their local communities. Then we have business owners hire new people because now they can afford to do that. And so we ask them, what is this tax bill preventing you to do in your business? Or what is this tax bill preventing you to do in your personal life with your family? Is it preventing you to buy that beach house or lake house? Or is it preventing you from hiring new people? And I love that
We're taking that vacation you
or
wanted to
taking
take.
the dream vacation. But what I love about it is now our clients have options. I mean, we have a great renewal for our clients every year because they see the value that we bring them. But what's more important is that we're putting them in a better position to prosper and to grow and to create wealth, and they get back. We've seen it. They get back to their communities, and that's what I love
Yeah.
about that.
And also, what do you have to lose by
Exactly.
not doing anything? You know, you're losing out on what you could have done
Yeah.
if you had that additional money to do those things that you wanted to do but couldn't do. Or what are you losing in the future in the case of Roth conversions and stuff like that? Because there is a cost to everything. Going back to cost. Right now, what is it costing you to listen to this podcast? Time. You're spending time listening to what we have to say
Yeah.
versus doing something else with your time. Now you have to choose what's more valuable to you, to listen to what we have to say or to go back and do what you would do otherwise.
Yeah.
Now, it might be time with your spouse or with your family, and I would say that's more important than listening to us at this moment. Hopefully your wife is listening as well. But
Or husband. Yeah.
or husband. But if you realize that there is an issue and that you have a problem, then I think the time you're spending here can potentially be very valuable to you.
Yeah. And it's all that's what I tell
And
my-
I'm not talking about money, by the way.
No. I'm talking. That's what I tell my clients all the time is that our clients that number one. Well, yeah, going back to money. Every client saves money. Every single client saves.
If you don't
saves
save money, then you shouldn't be our clients, and we'll tell you.
Yeah, we'll tell you. So all of our clients save money. We guarantee savings for our client, and like I mentioned before, there's nothing to lose whatsoever. Just jump into it, do it, and so I think the biggest tax or situation in someone's life is wasting time, not taking action, and not saying I'm too busy to meet 30 minutes with us, or not even with us, with another tax strategist anywhere, wherever you're from. We have clients from all over the country, but my point is you need to do something about it, and why procrastinate. We all deal with procrastination. Why it's not. Let's defeat that and just take that step and learning more.
Yeah, and maybe it's because you're listening to this and you don't know what to expect. And I like to put myself in your shoes at the other end of this podcast. Wherever you might be at home listening, you might be in your car, you might be at work. Hopefully you're not at work and getting in trouble. But or maybe you're at the beach. I don't know. It could be wherever you are. And maybe you're thinking, if I call these guys, what's gonna happen? I think the fear of the unknown, right? Well, I know I have a problem. I know I want help, but I don't know what's gonna happen when I talk to them. So
Yeah.
if it helps you sitting there, wherever you're sitting, can we talk about the steps that they would go through if they would make that call and talk to one of us, whether it's me or Jaime or Sergio or Lauren or any member of our team? What is the process? What can they expect?
Yeah, talk about
Because
the process a little bit.
one
'cause
of
I
the
think
things
that's
that
important.
I try to do with the people I talk to is set the expectation. This is what's gonna happen, or these are my goals. When I talk to somebody, so can we talk a little bit about that? I don't know if that would help.
Yeah, I think that's what some of the people may be hesitant. They don't know they're unaware of the process. They don't know what to expect, right? So yeah, you want to talk a little bit about. I know the first thing is picking up the phone and giving us a call and setting up the tax savings discovery call.
How are we doing it with the link where they get, they
Well,
reach out?
what you can, we're gonna give you guys our number. You can reach out to us, which is 956-567-9525, or you can there's gonna be a link in the description below. You can click on it. You can set an appointment with us, and you can check out some of our client testimonies as well. But yeah, so talk a little bit about that. So they initiate the call with us.
Okay.
And how does that work? I know
There's a questionnaire in there, right? Where they answer some basic questions about.
yeah, basic questions. You're gonna be getting there and just answer a couple of basic questions. Usually, it's gonna be their tax liability.
Okay.
How much have they been paying? If they're a business owner, W-2, registered investors. Basic information.
Okay.
They're gonna click on it, and then they're gonna get a phone call by either Lauren or Isaac to set an appointment with the strategist. Which Lauren is the strategist too, but when Isaac is busy doing other things, she calls as well.
Okay. So that gets you a spot on the calendar with
Yeah.
one of us, right? So once that spot is set up, you get an email with the information on how the Zoom or the Google Meet, probably Google Meet,
Yeah.
link is gonna work. And if you're, Google Meet is for most people is a simpler
Yeah.
thing to use. You just click on it, and if you have Chrome as a browser, then it's automatically there, right? So then you're gonna talk to somebody, a real person, whether it's Jaime, Sergio,
Mhm.
Lauren, or myself. And the very first thing is it's called a discovery call, right?
Yeah, so they're gonna book a discovery call with one of our tax advisors, and they're just gonna ask you a little bit, go into depth on your situation and to see how we can help you.
And I would say what you want to do in that call, if you're listening, is let them know what the issue is, because we want to know how much you've been paying in taxes and for how
Yes.
long, because we want to understand what the problem is. And also, if you're facing an upcoming situation, whether it's you're going to be retiring and you have this IRA that you're worried about, and you're thinking about a Roth conversion, that would also be helpful. If you're thinking about a major purchase like real estate or some other major purchase, that would also help.
Or they want to sell their business too.
Or you want to sell your business. We want to know about your family. Your kids. What are your plans for your business? Like you said, selling, maybe growing your business. We want to understand your situation because we want to align it with what our suggestions are going to be for your plan. Okay, and we also want to know if you're the type of client that we can work with.
Correct.
Because
It's an
Yeah.
it's a interview process for both,
yes,
right? But we are interviewing the client as well to see if they're right fit. If we're right fit to work with each other.
yes, because like I mentioned before, this is a relationship. It's kind of like you're going into marriage, right? You're going to get to know each other before you get married. That would be the smart thing to do. Well, a couple years ago there was a movie, right, with Salma Hayek, Fools Rush In, and what was that? The guy that passed away from Friends,
Yeah.
Matthew
Perry.
Yeah, Matthew Perry. Anyways, very interesting.
Yeah. It's not like that. It's not like that.
We don't want to. It was called Fools Rush In.
Yeah.
We don't want to rush in. We want to get to know each other. So that call is to get to know each other and see where we're fit. And because we've been doing this for quite a while now,
Yeah.
we can tell if you're the type of person we want to work with or we're able to work with, and we want you to feel comfortable to work with us as well.
Correct.
So at that point, we'll let you know, yes, we're fit for each other, or I don't think this is going to work for whatever reason. Maybe the savings don't justify what you're going to spend to work with us.
Correct.
Maybe it might be something else. Maybe you haven't filed your taxes for the last 5-7 years. maybe you say, well, I've been deducting all these expenses and I'm gonna keep doing them. Well, maybe we're not a right fit.
Yeah.
So at that point, what would be? Let's say we say yes, and you say yes. I think we're a right fit to work together.
So what we do, we're gonna go ahead and conduct what's called a tax assessment, and we're gonna look in your past filings. We're gonna see how much Uncle Sam plans to take from you from this year. We're gonna do a proactive approach, and we're gonna have the layout, the plan for them, and
Okay.
they're gonna be able to see exactly how much they're gonna save, how much is gonna go back in their pocket, and then they're gonna see the strategies that we're gonna implement, which we have different strategies, tier 1s, tier 2s, but we'll explain all that to them.
Okay.
From that particular point,
Wait, is there a cost for that?
though there is a cost for that.
Yeah, and I would say absolutely there's a cost.
Yeah.
If you're talking to other people online or you're talking to other people and they say, "Oh, it's free,"
Yeah.
then I would say sometimes you get what you pay for.
Yeah, and there is a cost, right? But the way we tell our clients is that you're using IRS money anyways. You're gonna pay
Yeah.
at the end of the day, and not only that, but we guarantee a savings. We can't guarantee at least 10,000 of savings. Which is very minimum. You're gonna get all your investment back. It's a fraction of what they're gonna pay the IRS.
And you know what? For me, it goes back to that relationship, and I compare it to marriage. So there is a cost. It's not a high cost, by the way.
No,
It's minimal, but it shows that you're committed, and it's
Correct.
going to show that we're committed. We had a client not too long ago who had a relative, I'm not going to say names, that was doing their taxes. They were a tax professional. Well, they started working with us, and during that process, we uncovered that certain things had not been done that should have been done.
yeah.
And
It was costing
part of the
client.
problem was because that relative said, "Don't pay me for my service." Well, now our client had nothing as a recourse. Hey, I paid you for this. You didn't get it done. Then they couldn't go back and say that. So when we take payment, we have an obligation to fulfill
Yes.
to you. And when you give us your payment, it shows us that you're committed.
Correct.
So it goes back to kind of like marriage. When you put that ring on that person, you make promises to each other. The husband says, "Be faithful, in sickness and health, to death do us apart." Right? The wife says, "I'll be faithful." What does the wife say? I don't even know what the wife says. But my point is that you both make commitments and promises to each other. There's a relationship, and we're entering into a relationship. You're gonna get a letter of engagement, and it goes back to marriage engagement, right?
Yeah.
Where we say we're gonna do certain things, and you're gonna do certain things. Otherwise, it's not gonna work.
Yeah.
If both parties in a marriage don't hold their end of the bargain, then that marriage is not gonna work.
Well, and also what we've seen, especially at the very beginning, we started doing this. We're doing those tax assessments for free, but what ends up happening is that our client never submits their paperwork because they have no skin in the game, right? So
Well, it's kind of like going to the gym, and they say, "Here's this gym. It's free. You can come in whenever you want." Great. I'll go tomorrow, and then tomorrow, and tomorrow. A month later, still haven't gone. It didn't cost me anything. If I go back and to a different gym and there's a guy there that says, "Well, the only way you can come in and get my services, I'm a
trainer.
I'm a trainer,
Yes.
and I'm world renowned. These are my qualifications. These are my students, and they used to weigh this much. Now, here they are. They weigh this much. These are our clients that you get testimonials. They used to have this big tax problem. Now they
I rather pay him
So you pay him. You
some
pay them-
accountability.
Yeah, some amount,
Yeah.
whether it's high or low. But now you say, I paid this guy. I'm gonna go
Exactly.
because you're committed.
Yeah.
And if we get somebody and they pay us, I know they're committed.
Yeah.
And we're committed as well because now we have an obligation to fulfill to you.
Yeah.
And we have a letter of engagement where it spells out what our responsibilities are to you, and it spells out what your responsibilities are, which are mostly give us the paperwork that we're gonna need to fulfill our work.
It's very simple, guys. It's very, very simple. Eddie, let's talk about end results. So, so far this year, I mean, we saved our clients tons of
I
money.
think the last figure we were looking at, we were getting close to 5 million.
Yeah, and it's only half of the year, or a little bit more than half of the year. What's the? I know last year we had some big clients, and they're coming. They're still renewing with us. But what's been the biggest one that we've seen this year that we're gonna end up saving our client?
I think the one that we're saving them over 600,000.
$600,000. I was gonna go to the IRS.
Yeah. That's gonna
Man,
go to the
that's a
IRS.
lot. That's a lot of money, man.
Yeah. That's over $500,000 that was gonna go to the IRS.
And imagine, I'm sure he's been paying $600,000, say, for the past 10 years. That's a lot of money.
Yeah, that's a lot of money.
So at $6 million.
As a matter of fact, right before we started this, I was taking some calls, and he was one of the calls because he wanted to know, hey, when can I start doing this other thing that we were waiting because we were waiting
Yeah.
on the result of something that just came through for him, and I said, go ahead, you can start. He wanted to increase his business and build more, expand. Now he can do that because he doesn't have to pay that,
Man,
and that's gonna affect his neighborhood, his community, his city, and the state, and ultimately the country, right? So, because I believe that person can do more with that 600,000 than Uncle Sam can do with the 600,000.
yeah, it goes to money that we don't even know where it goes to, or
That's
programs that we may not like.
Yeah, that's my opinion, and I'm entitled to my opinion. You're entitled to yours. You might say,
Yeah.
no, you might say Uncle Sam can do a better job with the 600,000, and you're entitled to that opinion. And we might not be able to work with somebody like that.
Man, I was looking at some ranch property online. I'm looking for a ranch to purchase, and one of them well, there's a few that I like, but one of them is $600,000. I mean, in this man's case, he doesn't have to finance anything if he doesn't want to. He wants to just invest it in raw land like that, dump it in there, man. That's amazing. That just goes to show you how much $600,000 is, how much purchasing power that client now has. What he wants to do with it, whether he wants to save it,
Yeah.
he wants to reinvest in his business, or buy more property. I know he has a lot of property. Buy more property. I mean, it's
But in this case,
amazing.
it's not really the 600,000. It's gonna be the jobs he's gonna create.
Yes,
Now he's in the medical industry, so the people that he's gonna help
jobs.
with
I mean,
their health.
that's amazing.
So he's gonna affect his community, and there's we have sales tax, we have property tax in Texas, so there's still taxes that are being paid.
Oh yeah, gas tax.
And unfortunately, I wish we could affect all of them. We can't. We don't do property taxes. We don't do sales
Yeah.
tax. We have sales tax here in Texas. We don't have state income tax, but we do have a lot of
Yeah,
property taxes, big time. There's some experts in that area,
yeah.
and if you're in Texas, you can talk to them about property taxes. But if you're worried about federal taxes, and if you're in a state that has state taxes, we can affect those. Even though there might be limitations like New York or California, we can still affect it.
Yeah, we can still pay in some states. So what type of client are we looking for? Talking about income wise.
So, if we're just looking at reducing taxes because of their income, I would say where it really makes sense is anybody. What would you say over?
250.
Over, yeah, about two hundred.
That's at the minimum. So Usually, someone making 250. How much are they paying in taxes? About 50,000 at least.
Well, if let's say they're married, right? If we look at the federal tax brackets, and they're married, I think they're like at the 20 something percent, 22. Let me see. I'll tell you right now. Married, and they're making about 250. You said?
Yeah, combined income.
24% tax bracket. So, about a quarter of your money is, and I would say more probably effective rate, maybe more like a 20%. Let's say 1/5 of your money is going to Uncle Sam.
Yeah.
And if you're W-2, say, well, no, I don't pay that much in taxes.
So you do.
Look at your tax return, and I think line 22
I think
on
so.
the 1040, it says total tax. Look at that number. Because if you're working for somebody, you have something called W-4, and they're taking out a portion of your paycheck every time you get paid that goes to Uncle Sam. And that's the real number, what you pay there, plus anything else that you pay when you file your taxes.
Well, that's what I love about helping W-2 employees, because they get those big old refund checks, and they're like, "What? I never
I've
had
never
that
gotten
check."
a refund.
Yeah, I never got refunds like that, or this amount of money. That's what
Yeah.
I really enjoy. We're helping W-2 employees.
We have one that's waiting over 100,000 refund.
$100,000 refund.
Yeah, where they normally they would pay.
And this goes for especially new families, right? People in new families. The cost of tuition of college is going up dramatically. Imagine that $100,000 check, refund check, or $50,000 refund check, or $20,000 refund check. That can go straight to a savings account for their kids for college.
Yeah,
I mean, that's amazing. It's amazing what
or
that.
maybe they're already in college.
Yeah,
Yeah, and
they need money
and it's
to.
expensive.
Yeah. Oh man, it's very expensive.
Or, if you want to be a doctor and have your own practice, it's like you're 30 years old before you can do it. Late 20s or early 30s, so it's
Student loans. They have tons of student loans.
Yeah, it's
especially doctors.
very expensive.
Yeah. So the good thing is that we can help them. We can help them
Absolutely.
recover some of that money, and they can go down to paying their student loans. I mean, the possibilities are endless, man. That's what I like what we do. Solutions.
Absolutely.
But all right, Ed. Well, hey, we're here to help you guys out. Make sure to give us a call at 567-956-567-9525. There's also going to be a link in the description below. You can book a call with us. You can answer a couple of questions. You can book a call with us. Eddie and I, and we also have Lauren and Sergio that are ready to help you guys. So we look forward to hearing from you guys. Eddie, any last words?
I think there's a lot more information now than before. In the past, and people are becoming more and more aware of what they can do. And when we have spoken to other people that come to us from, they saw us on Facebook, they saw us somewhere online, they might have spoken to other people before, and I go back to where they say, well, they're doing this assessment at no cost, free. And my first question is, well, why didn't you do it?
Yes. Yeah.
Uh,
What are you looking for?
Yeah, and I get different answers, but I think it goes back to number one, trust. Right? If you need to be able to believe that person can do what they say they can do, and number two, commitment. Because they did offer it to you for free, you weren't committed. So I would invite you, if you're uncomfortable with the way things are, whether it's because of you have an IRA that's going to be taxable, or because you're paying this high amount of taxes, and you're tired of being tired, and you're looking for an answer, we can help you.
Yes.
and we know we can get results. You can see our testimonials. You can talk to us, and there is a cost. There's no such thing as something for nothing, but what you're gonna pay is gonna be well worth what you're gonna get. And if it's not, then we'll tell you, you know what, I don't think it's gonna work. I think it's better you keep it the way it is, or we suggest this, that you do this. So I'm not saying we can help everybody, but I'm saying we can help a lot of people.
We can help a lot of people.
And the only way we're gonna find out is if we talk.
Yeah, and it goes back to that conversation. I mean, recently I had a person that owns a business, and they've been wanting to sell for a long time, but they didn't want to sell because of the tax hit that they're going to get. Well, we have solutions for that, guys. So hope to hear from you guys soon, and stay tuned to the next podcast. All right, God bless. Bye-bye.
Bye-bye.